If you are thinking about buying real estate in 2026, please do not touch your money yet, because right now, there are 6 cities across America where home values are quietly collapsing, and most buyers have absolutely no idea what is going on. Everyone, welcome back. If you are new here, this channel is your no BS guide to the US housing market. We don't sugarcoat, we don't hype, we give you the real numbers so you can make smart decisions with your money. And today's video might be the most important one I've made all year, because I've spent the last 3 weeks deep in housing data, MLS reports, census migration numbers, foreclosure filings, insurance cost analysis, unemployment trends, and what I found in these 6 cities genuinely shocked me. These are not random cities either. Some of them were the hottest real estate markets just 2 or 3 years ago. Cities people were moving to in massive numbers. Cities where investors were throwing cash offers left and right. And now, the tables have completely turned. So stay with me through this entire video, because the last city on this list, most people will not see it coming. And I'll also give you a clear framework at the end so you know exactly how to protect yourself, whether you're a buyer, a seller, or an investor. Let's get into it. Before I name the cities, you need to understand why 2026 is creating this specific type of danger in certain markets. Because this isn't just a prices went up too fast story. There are 4 forces hitting certain cities at the exact same time right now. Force number 1, insurance costs have gone completely out of control. In certain states, homeowners insurance has gone up 40, 50, even 80% in just 2 years. Why climate risk, hurricane damage, flooding, wildfires? Insurance companies are pulling out of entire states. And when they pull out, home values follow them down. You cannot sell a house that nobody can insure. Force number 2, mortgage rates are still painful. We are still sitting in a world where the average 30-year fixed mortgage rate is hovering near 7%. That is not a market where buyers are lined up around the block. Affordability is at a near historic low. And in cities where prices ran up the most aggressively during 2020 to 2022, those markets are now the most vulnerable because they have the furthest to fall. Force number 3, population is shifting. The remote work boom sent millions of Americans scrambling to affordable mid-sized cities. But now, companies are calling people back to offices. And many of those people who relocated, they are quietly looking for the exit. When the population moves out, demand drops. When demand drops, prices follow. Force number 4, new construction oversupply. Builders got very aggressive during the pandemic boom years. And now in several markets, there is a wave of brand new homes coming to market, right as buyer demand is softening. That is a dangerous combination. Too many homes, not enough buyers. That is how you get a buyer's market that turns into a price correction. Now combine all 4 of these forces, and you get the cities I'm about to show you. Starting with the one that is going to get the most comments, Austin, Texas. Look, I know Austin has been the golden child of real estate for years. Tech companies, Tesla, Oracle, people were moving there in droves. Home prices went absolutely insane. The median home price in Austin hit nearly $550,000 at its peak. Here's the reality check in 2026. Austin's active housing inventory has increased by over 50% compared to just 2 years ago. Homes are sitting on the market longer. Price cuts are everywhere. The median home price has already pulled back significantly from that peak, and analysts are projecting continued softening through 2026. Why? Because Austin overbuilt massively. New construction permits exploded during the boom, and now those homes are hitting the market all at once, right as some of those tech workers are being called back to San Francisco or Seattle. Additionally, property taxes in Texas are brutal. No state income tax sounds great, but Texas makes up for it with property taxes that are among the highest in the nation. In Austin specifically, you're looking at effective property tax rates that can hit 2.2% or higher. On a $450,000 home, that's nearly $10,000 per year just in property taxes, before insurance, before mortgage, before anything else. If you are an investor looking at Austin cash flow, the numbers simply do not work right now. And if you are a buyer hoping to build equity quickly, you may be buying into continued depreciation. Austin is not dead forever, but in 2026, the risk is real and the timing is bad. Florida has been one of the most chaotic real estate stories in recent memory. And while Miami and Tampa get most of the attention, Jacksonville is quietly becoming one of the most dangerous markets in the state. Here's the core problem. Insurance. Florida's property insurance market is in a full-blown crisis. Multiple insurers have already left the state entirely. The ones that remain have raised rates dramatically. In Jacksonville specifically, which sits in a flood-prone coastal and river area, homeowners are dealing with insurance costs that have doubled or even tripled in just 3 years. Think about what that does to affordability. You find a home priced at $320,000. Mortgage payment feels manageable, and then you find out your insurance is going to cost you $6,000, $7,000, even $8,000 per year. Suddenly that affordable home is not so affordable, and buyers are figuring this out. Days on market in Jacksonville have increased significantly. Inventory is climbing, and sellers who bought at peak 2022 prices are now stuck because buyers are either unable to afford the true cost of ownership or they are simply choosing not to take on that risk. Jacksonville also has a rising crime concern in certain zip codes, a school system that scores below national averages, and a job market that, while improving, is still heavily dependent on military and healthcare sectors that don't drive massive wage growth. This is a city where you need to be very selective if you invest. Wrong zip code, wrong property type, wrong insurance situation, and you could be in serious trouble. Memphis makes this list for a completely different set of reasons, and this one is important for investors specifically. Memphis has been marketed aggressively to out-of-state real estate investors for years. High cash flow, affordable prices, strong rental demand, and on the surface, the numbers look appealing. You can still find single-family homes in Memphis for $120,000 to $180,000. That sounds incredible compared to coastal markets. But here is what the sales pitch leaves out. Memphis consistently ranks as one of the highest crime rate cities in the United States. Property crime and violent crime rates in many Memphis zip codes are dramatically above the national average. And high crime does something very specific to real estate. It suppresses price appreciation, it increases vacancy rates, and it attracts tenants who create higher turnover and property damage costs. Second issue, Memphis has one of the highest eviction rates in the country. Managing a rental property in Memphis from out of state is genuinely challenging, and many investors who bought there based on spreadsheet projections have found that the reality on the ground is very different. Third, Memphis has seen population stagnation. The city is not growing meaningfully, and in real estate, population growth is oxygen. Without it, price appreciation is extremely limited. If someone is pitching you a turnkey rental property in Memphis right now, I would tell you to do extremely deep due diligence before you write that check. The cash flow projections often do not survive contact with reality. New Orleans is a city with an absolutely incredible culture. The food, the music, the history. There is nowhere in America quite like it. But as a real estate investment in 2026, this is one of the most challenging markets in the country. The insurance crisis in Louisiana is arguably even worse than Florida. Louisiana has lost more insurance providers per capita than almost any other state. Citizens Property Insurance, the state-backed insurer of last resort, has seen its rates skyrocket. Some homeowners in the New Orleans metro are paying insurance costs that represent 3%, 4%, even 5% of their home's value per year. That is extraordinary. Add to that, New Orleans has had persistent population decline. The metro population today is still below its pre-Katrina levels. Nearly 20 years later, that tells you something very important about long-term demand. The city also faces ongoing infrastructure challenges, flooding risk that is worsening with climate patterns, and a local economy that leans heavily on tourism, which makes it vulnerable to economic downturns. Now, there are investors making money in New Orleans. Short-term rentals in the French Quarter and certain neighborhoods can generate strong revenue. But that is a very specific, very hands-on strategy. For a traditional buy-and-hold real estate investor, New Orleans carries significant risk that many people are simply not pricing in correctly. Boise might be the biggest surprise on this list, and the most instructive story about what happens when a housing market goes from zero to hero and then back again too fast. Just 4 years ago, Boise was the darling of the housing market. During 2020 and 2021, Boise was one of the fastest appreciating real estate markets in the entire country. Remote workers flooded in from California. Prices went up 40, 50, 60% in some neighborhoods in just 18 months. And then the correction hit. Boise has already seen some of the steepest price pullbacks of any market in the U.S. since the 2022 peak. Home values dropped significantly. Some reports showed 15 to 20% corrections in certain submarkets. And while prices have partially stabilized, the market is still working through excess inventory and affordability challenges. Here's the Boise math problem. Wages in Boise have not kept pace with the home prices that were set during the pandemic frenzy. The people who actually live and work in Boise cannot comfortably afford medium-priced homes there. And the California transplants who drove prices up, many of them either left or stopped coming as remote work policies tightened. Boise still has things going for it long-term: quality of life, outdoor recreation, lower cost than coastal cities. But in 2026, buying at current prices still means you are potentially buying above fundamental value. Patience is required. This is not the market for a quick flip or aggressive appreciation bet. And here is the one I promised you would not see coming: Phoenix, Arizona. Wait, isn't Phoenix always on the hot markets list? And that is exactly the problem. Phoenix grew so fast, so aggressively, and attracted so much speculative investment that the market is now sitting on a foundation that is shakier than it looks on the surface. Here are the real numbers. Phoenix saw a massive inventory surge in 2023 and 2024. Active listings jumped dramatically. Price cuts became extremely common. And while the market showed some stabilization, 2026 is bringing new pressure, specifically from two directions. First, this sounds almost too simple, but Phoenix summers are becoming increasingly extreme. Consecutive days over 115 degrees Fahrenheit, rising electricity bills, and a growing conversation among researchers and economists about whether Phoenix's long-term livability is at risk as climate patterns intensify. Some demographic research now shows a measurable slowdown in net migration into Phoenix, specifically tied to heat concerns. Second, water. Arizona's water situation, specifically the Colorado River water allocation crisis, is not resolved. Long-term, this is a genuine existential question for continued growth in Phoenix. And smart institutional investors are absolutely paying attention to it. Phoenix is not collapsing. Let me be clear. But for a buyer or investor in 2026 thinking about a 5 to 10-year hold, these are risks that are very real and very underpriced in the current market. So what do you actually do with all of this? Here is the 3-part framework I use when evaluating any market before putting money in. Number 1, check the population trend over 5 years, not 1 year. Short-term blips happen. What you want to see is a consistent, multi-year trend of people moving in and jobs being created. If the 5-year trend is flat or negative, be very cautious. Number 2, run the true cost of ownership, not just the mortgage, property taxes, insurance, Get actual quotes before you make an offer, not estimates. HOA fees if applicable. Average maintenance costs for that property type and age. When you add all of that up, does the math still work? If it doesn't cash flow and it doesn't have strong appreciation potential, there is no investment case. Number 3, ask the insurance question first. Before you fall in love with a property, call an insurance broker and ask, "Can I get coverage on this property, and what will it cost?" In Florida, Louisiana, and parts of Texas and Arizona right now, the answer to that question will save you from making a catastrophic mistake. These 3 steps alone will protect you from 90% of the bad real estate decisions happening in America right now. Here is my final thought, and I want you to really hear this. Real estate is still one of the best wealth-building tools in America. I genuinely believe that, but only when you buy the right asset in the right market at the right time, with your eyes wide open. The cities I showed you today are not necessarily bad forever. Market cycle, things change. Austin will recover, Phoenix will recover. But in 2026, with the specific combination of factors hitting these markets right now, the risk-to-reward ratio is simply not in your favor. There are markets in America right now where the fundamentals are strong, prices are fair, population is growing, and the insurance situation is manageable. Those are where your energy and your capital deserve to go. I will be covering those best markets in my very next video, so make sure you are subscribed and have the bell notification on so you don't miss it. If this video helped you, hit that like button. It genuinely helps this channel reach more people who need to hear this information before they make a decision they'll regret. Drop a comment below. Which city surprised you the most on this list? I read every single comment. I'll see you in the next one. This video only for education purpose.